now it's over to Ritu. She's compiled what brokerages have said on the India-US deal and the way forward. Ritu.
Well, no two ways about this. The street sees this India-US trade deal as a clear growth positive. So Barclays, for instance, calculates that the India trade-weighted tariff on exports is going to fall to around 16.3% from 35.7%, which is the effective tariff currently. And that's a meaningful reduction in the trade cost, which puts India firmly back in the trade competitiveness play. But Barclays also warns that some of the key conditions are still unresolved. So India's stance on Russian oil purchases, the commitment to buy large volumes of US goods, these are not mentioned by Prime Minister Modi in his tweet anywhere. And these are the factors that are going to influence how the deal plays out in practice. So fine print is something we still have to wait for. But if history is any guide, we've seen what happened with South Korea and Canada, where initial tariffs underwent big changes, and you can't really rule that out with US President Trump. But Barclays says markets have probably priced in the best possible outcome as of now. They're also not rushing to change the FY 26-27 GDP growth forecast, which is still retained at 6.5%. From JPMorgan's standpoint, export-oriented sectors like your textiles, gems and jewelry, leather, chemicals, etc., they stand to benefit the most, with potential for increased foreign investment there, a stronger rupee and clearer earnings outlook. They also reaffirmed their nifty year-end target of 30,000. Bank of America takes it even more optimistic view. They estimate that the effective tariff can drop all the way to 12 to 13%, and that gives India one of the most competitive export tariff rate in the region. They also see this as providing significant relief, especially for labor-intensive segments, and point to an upside risk to India's FY 27 growth of around 6.8%.
Well, absolutely, and this has done its job.